In this video, we're going to look at interest and APR. So let's get straight to it. What is interest? Interest is a price tag or cost on money that has been borrowed. It is charged to the borrower periodically until the money is repaid in full. Now, the ability to borrow money is very useful to the borrower, but to the lender it can be an inconvenience and even a risk. So interest acts as an incentive that encourages the lender to lend out the money and the borrower to repay it as soon as possible. Interest is normally expressed as a percentage of the sum borrowed, and the actual rate issued is usually determined by the lender. So traditionally, financial institutions like banks will charge interest on money lent out to customers as debt, and also pay interest on money held by customers using their accounts as savings. But this is no longer always the case. Anyhow, it is important to be aware that there are two main forms of interest: simple and compound, and knowing the difference between them could pay off well. So a borrower can be charged simple interest. In this case, the price tag on the money borrowed will be a product of the rate issued, the amount borrowed, which is also known as principal, and the duration of the loan. In most cases, the borrower will be charged compound interest. This can sometimes be much more costly because the interest charged on the money borrowed is each time calculated using cumulative amount owed, meaning it includes any previous interest owed. So, if you've ever taken out a mortgage, a personal loan, a credit card, or used other credit facilities, then you may well be familiar with APR, annual percentage interest. Now, APR represents the average cost you will pay over a period of 1 year in fees and interest for the money you owe. Now, let's say you apply for a credit card, and after assessment, the bank approves your application and issues you a credit limit of £1,200 to be repaid over 12 months at an APR of 35%. So what does that mean? Well, in addition to repaying the £1,200 you borrowed, it will also cost you an average of £420 a year in fees and interest. So I would say APR is like a ready-made sandwich made up of interest rate and lender fees. Rates set by the bank are influenced by level of demand for credit as well as level of inflation in the economy, and these are subject to change. Lender fees, on the other hand, will vary from lender to lender and may include charges for account usage, late payment, for exceeding credit limit, as well as other services. So you don't get to choose what's in it, but perhaps you can avoid eating the extra fillings you don't like. Moreover, APR interest rates are greatly affected by individual factors, like the amount being borrowed and the duration of the loan. Don't forget the credit history of the borrower and the borrower history or relationship with the lender. So all of these factors will affect the final rate given. There are different types of APR, and it's useful to know which ones you're dealing with before you sign any paperwork. For example, fixed APR, which will not change unless you fail to meet your repayments. And there's variable APR, which will change depending on what's going on in the world. And we also have representative APR, which is a rate the lender offers to 51% of applicants. There's also typical APR, which is a rate that by law the lender offers to at least 2/3 of their applicants. And there's also introductory APR, which is a lower rate offered to new customers, which lasts for about 6 months. I'm sure there are probably more types of APR, but it's always useful to know which APR you're dealing with before you sign any paperwork. Now remember, not all interest is APR. For example, flat interest rate loans. These are not calculated based on the amount owed, but calculated using the original amount borrowed. So even though you may have made some repayments on your loan, the interest rate will still be calculated based on the original amount borrowed, meaning the principal. So always check to be sure. Alright, so what is interest? Interest is a price tag or cost on money that has been borrowed. It is charged to the borrower periodically until the money is repaid in full. APR is a combination of interest rate and lender fees. It is a type of interest, but it represents the average annual cost to the borrower for money they owe. So I know that was a lot of information, but I hope you found this video helpful. Thanks for watching.